Welcome to the Real Estate Investing Academy, your number one source for all things real estate investing and personal finance. With your host, Tom Staub. Welcome, everyone. This is podcast number 4, episode number 4. Before we get started, we have a big lineup coming up with some big guests, so stay tuned for that, including one guest who's a CFA, which is, I went through that test and I opened the books and I said, forget this is ridiculous. And he manages over $1 billion in assets, so we'll get him on here to understand how he's managing his clients' portfolios. But today's topic, I want to hit on 2 of them. The first one is what I'm seeing in the markets that really concerns me. It's the flood of novice investors playing the game that they really don't know how to play. And then the second one is, okay, well, I can't just complain about it. I want to give you all a theory or a concept that I've been using for some time that's been proven in the market. And so we'll deep dive into that as well. Okay. So with that said, let's open it up. Okay. I'll tell you, when I look at the markets, I read the journal every day and I look at the articles that I read, we can all see since March, there's been a huge influx of assets to the market for a number of reasons, whether it be flight to safety, stability, false hopes on rebounds, you name it. But one of the big ones that I've seen is new investors flooding the market to play the games. And I'll tell you, it's tempting. I know, I've been there, I've done it, I get it. It's tempting to want to put your money in what seems to be guaranteed returns. And it's funny because, well, it's not funny really, but it's interesting because this has reminiscence of 1928, 29 going into the crash, right? Put your money in stocks, a guaranteed success, a guaranteed win. And people are just flooding the markets, and it's herd mentality. And when this term, which is what is called emotional exuberance, takes place in the market, if there is a correction, the herd follows that too, causing massive corrections. And so it's a really dangerous situation that we're in when we see, growths from March up 40, 50% in certain assets, gold's up substantially, silver's up like 60% year to date, or from March to date. It's just crazy numbers right now. And so the fear is, though, they're putting their money in these assets and they're high earners. They have jobs, they have money, and there are other investments that you can put your money in and get substantial returns. And I'll tell you, we know from history as well, when an election happens, if it's unfavorable for, business, if it's unfavorable for tax policy, if it's unfavorable for general free market policies, there's usually a pullback. Now, I don't know if you're looking at the polls, and I'm not going to get into politics here, but Mr. Biden, even by Fox News polls, is up at least an 8-point spread. And they're keeping him quiet to hold that spread. And I think unless there's a way for Trump to pull around the coronavirus and get this economy back into place, it's going to be a hard win for him. In fact, I believe it's more than 85% of the time, and it might even be as high as 90% of the time, the party in power during a good economy retains office or wins. The party in power during a down economy loses. And again, that's another variable that could be against them. I'm not trying to be political here, but I think it's important to know that there is a real risk that if Biden gets elected, there is a correction in the market. And you couple that with the herd mentality, you couple that with the second wave of corona that's now taking place, and really hasn't shown us true colors yet in commercial real estate or any sort of other asset class. I think there is risk. And those that are playing in the market, not playing the right game, are very exposed. Okay. So today I wanted to first make that clear that I'm concerned for you all if you're just playing in the market. This is not the time to be playing in markets. Okay. So if you want to play in the markets, what do? I know it's fun. It is. I like to play as well. I try not to because it can lead to demise. If you're going to do it, one of the quick policies that I have in my own personal portfolio is to invest no more than 20%. If you're young, 20%. If you're getting up into your 40s, 50s, want more stability in your nest egg, no more than 10% of your portfolio is speculative. The rest is in a stable strategy. Now, I know stability is boring, okay, but boring is good when it comes to investments. Boring in singles, sometimes doubles is good. You don't need home runs to make it big, okay? One strategy that I want to talk about was developed by arguably the world's most successful hedge fund manager, Ray Dalio. Now, I'm a fan of Ray Dalio. He's had a pretty rough year this year. He has two main funds, right? Now, he did manage about 180 billion. It's down to about 160 billion dollars of assets. His company probably makes between 140 to 180 million dollars a year in revenue to do that. Very successful. They have two funds. The first one's called the Alpha Fund. This is for your higher prized client that has a lot of wealth. This fund tends to beat the market. It's geared towards growth and more risk. He has another fund that has a very low expense ratio. And this fund is based on a strategy that's called the all-weather portfolio. And on my YouTube channel, I have a brief description of what that is down below in the other masters lessons, okay? But essentially, it's broken up into a few categories. He says, look, and I agree with him, and this is what we're taught in finance in our graduate school and PhD. It's that a return on your portfolio is not just about the return, right? It's about the risk that you are exposed to. And so what's interesting is that when you look at his portfolio, the first thing he says is like, look, when it comes to equities or it comes to stocks, the most you can ever have in your portfolio is 30%. Okay, according to this strategy. And I'll tell you, by the way, the strategy, the all-weather portfolio strategy, has consistently beaten the S&P 500 by about 0.5% to 1%. But the risk exposure is less than half, meaning that you get the same returns as the S&P typically. So sometimes less, sometimes more, but the risk is substantially lower. The biggest one-time dip this ever had, this strategy, was 6%. Okay, so through the crashes of 87, through the dot-com bubble burst, through the 08 housing crisis, this had only seen a 6% dip at any time. And so I didn't know what to think of it. So I first tried it out, and it's been very stable for me as well. Tony Robbins is a big believer in this as well. This is how he manages his money as well. Okay. So again, back to the formula. Ray Dalio says, I want no more than 30% of my assets in this portfolio to be in equities or stocks. Okay. So 30%. Now, another category is bonds. Now, I know they're not sexy, right? But if you look at right now, the flight to safety, bonds, depending where you're playing, if you're in the long-term bonds ETF, I'm up 16 to 18% this year alone just on that long-term bonds ETF due to a number of reasons. But one of the big ones is flight to safety. They're guaranteed returns, so they have little risk. That helps lower the risk from the equities and the stocks. Now, in this portfolio, he has 40% tied to long-term bonds. Okay, so 20-year plus bonds, ticker symbol TLT, very, very low expense ratio. That's what I use in my portfolio. He then has another 15% in intermediate bonds, so 3 to 7 year bonds. And again, in my video, you can see the ticker to get that, IEI, very low expense ratio as well. And that year to date, I believe, let's see, IEI, is it 19%? For the year, up from 130, no, 1 year, 130, yeah, 9, 10%. Okay. So that's up 10% this year. So again, so intermediate bonds, 3 to 7 years, 15% of your portfolio into that. And then he has 7.5% in a gold ETF. Okay. Again, gold has had a tremendous year. Okay. And then lastly, he has 7.5% in a commodities ETF. Okay. So when you think about what this is doing, this portfolio is hedged for inflation. It's hedged for deflation. It's hedged for growth runs with the S&P. It's hedged for flight to safeties or corrections. So it really came about when it was made public when Tony Robbins was with him in an interview, and he said, Ray, look, you're getting older, you've made your money. If there's one thing that you could tell the small investor on how to manage their money for long-term wealth, what would it be? And Ray shared the secret of this all-weather portfolio, which is also in the book by Tony Robbins. So point is, it's got a big following. There are actually funds and ETFs that follow the all-weather portfolio itself, making it even easier. But I like to manage it myself. And what I do is every month I have an amount that I allocate towards it. And I go into my tracker, as I have mentioned in other episodes, and I see where the weights are. And basically, you're just managing every month or so, buying more of the assets to keep your weights the same. And that's the beauty. Top of that, there's another video on my other lessons by masters on our YouTube channel that talks about dividend reinvestment programs, DRIP programs. So what's beauty about the bonds, those ETFs, they pay dividends. So you can set up on Robinhood.com, which is what I use for my trading platform. You can set up the ability to reinvest those dividends back into those ETFs. So it's a really nice portfolio, and that's one of the key pieces to my overall investment strategy. So when you look at my strategy, like I said before in the beginning episodes, I have a third in private money lending, I have a third in hard assets like real estate, and I have a third in this all-weather portfolio. And so, look, again, I know it's tempting to be out there in the markets right now. Everything's going up. November is not too far away. Do be careful of that correction that might happen if Biden wins. Do be careful of what this, second or soon to be, who knows, third wave of coronavirus might do to the overall economy. Just don't play with your money. Put it to use. Be boring with it and put it in strategies that work. And if you're going to play with your money, allocate a portion. Don't become a day trader. And I'll leave you with this last fact. Okay. On an annual basis, those who work on Wall Street full time, money managers, people who, my friend who's a CFA who will be on this podcast soon. On average, only 8%, 1 out of 12, beat the market. 8%. And these people are CFAs. They're taught, they're schooled. They do this all day long, 60 hours a week. And only 8% of them beat the market. Okay. Now here's the thing. Year over year, to do it consecutively is substantially lower than that. So for you to think that you can go out while you're working your W-2 job and pick the winners and beat the market is not only foolish, it's irresponsible. And so take care of your money, be wise with it, and put it in assets that produce income. Or if you're going to play in the market, do it with a plan and do it responsibly. So with that said, we have more podcasts coming up. I'll have some more guests. I can't wait to have them on. And any questions, you know where to reach me. And we just launched our new website, reiacademy.co. reiacademy.co. Please subscribe to the channels. It keeps us up in business. And I'll see you soon. Thanks, everyone.